Hello, my name is Grant Joyner. I am the founder of Vineyard Wealth Group. I'm a certified financial planner professional and an enrolled agent, which means I can do taxes and represent people before the IRS. And today we're going to be talking about tax integrated financial planning. We're Vineyard Wealth Group, and one of the things that makes us unique to a lot of financial advisors out there is that we not only manage investment assets, but we prepare tax returns. And so a lot of financial advisors are really just investment managers, and they're purely talking about investment management. And that is one piece of the puzzle, but here at Vineyard Wealth Group, we want to do the whole puzzle. So we are trying to not only do a great job of managing assets, but really focusing on what that means for the after-tax dollars for you as the consumer, because ultimately that's the most important thing. If you get great returns, but you're getting a massive tax drag, that's not helping you a ton. So let's jump into it today. More than investments, how do you coordinate taxes, investments, and distributions to maximize your after-tax wealth? We are primarily going to be focusing on sort of 5 areas: asset location, not only just what you hold, but where you hold it; tax loss harvesting, how can you take positions that aren't doing well and sell them and offset gains or ordinary income; Roth conversions, how can you take big buckets of pre-tax money, convert them to Roth and do it at a low tax bracket; required minimum distribution management, or RMDs, that's when you have money in tax deferred vehicles that you've got to take out; and then income timing strategies. How do you bring this all together and make sure that your income is timed up to meet your needs in the most tax efficient way possible? So first off, let's just look at sort of the hidden cost of a tax drag. And in this particular example, we're talking about the growth of a $100,000 investment over 30 years with an 8% annual return. And on the left, you can see with no tax drag, we're basically at $1 million. And then as we move down the line, the more tax drag we have, the more we have an impact on the after-tax dollars, right? And in a case like this, we are looking at a scenario where with a 1.45%, 1.48% tax drag, you're looking at a $345,000 difference if you get zero tax drag. It's not really possible oftentimes to have like a 0% tax drag, but on average, if you're saying 0.5% to 2%, some of this boils down to how can you minimize that to make sure that you're over your lifetime getting the maximum after-tax return. And so let's talk about the right assets for the right accounts, right? And so there's this idea that, let's say you want a 60-40 portfolio, 60% risk on and 40% risk off assets. It doesn't mean that all of your accounts should hold the same investments. Some investments are better to be held in different accounts because of the way that they operate, whether they kick off dividends and interest and how they're taxed. And so let's just talk about taxable accounts. What you want in taxable accounts is things that are going to grow, but hopefully not spit off a bunch of dividends and interest along the way, and certainly not forced capital gains like a mutual fund, which when they do their trading and if they have a gain, they have to force that on you even if you didn't sell anything. So index funds, especially exchange traded fund index funds, long-term growth stocks, because most growth stocks aren't paying dividends, municipal bonds, they're just not taxable outright, and then US savings bonds, which have some advantages, and treasuries have some taxation advantages. In tax deferred accounts, you can hold basically everything in tax deferred accounts because effectively in those you are not paying taxes on a growth, dividends, or interest. So if you do hold things that, like a REIT, a real estate investment trust that's spitting off, 6, 7, 8, 9, 10% in distributions, holding it in a tax deferred vehicle is a great way to minimize taxes. And then ultimately in Roth IRAs, where you're getting tax-free growth, this is really where you want your high-flying, highest growth assets, because that would be tax-free growth. And you want things that are going to grow the most, and hopefully you get basically to avoid all taxes with that. So in that example, we have a 60-40 portfolio. Not each one of these accounts being 60-40, but maybe the Roth IRA is 100% risk on, the taxable accounts 50-50, the tax deferred accounts 50-50. You can see how you can manipulate these things to make sure that you have the right allocation at a big picture level, but that each account is structured specifically for what that account should hold to minimize your taxes. So making market losses work for you. This is with tax loss harvesting, right? And so how do you tax loss harvest? Let's say you bought something for $10,000 and now it's worth $5,000. If you sell that, you will have a capital loss. Less than a year, it's a short-term loss. More than a year, long-term loss. That capital loss can do things for you. It can basically offset ordinary income to the tune of $3,000. And if you only could recognize $3,000 of that versus your ordinary income, that $2,000 in that case would move forward. But can it offset other gains that you would have in the portfolio? And it's not a situation, if you were to sell it and buy it right back, that would be a wash. So you have 30 days where you can't buy back that security or something substantially identical. But oftentimes you can replace it with an exchange traded fund, something in that sector, or another company, Coke, Pepsi, something like that, or you could buy something that's very similar to keep your exposure. But lots of opportunities if you have a hands-on-the-wheel approach to tax loss harvest to minimize taxes on a year-over-year and long-term basis. And let's talk about a situation where you have the same dollars. So this is a hypothetical example, but two very different tax bills. And this is going to be a married couple with substantial traditional IRA assets. I see this frequently. You have people where the majority of their liquid assets are living in 401ks and IRAs where they were diligently saving through their employer, and those are their biggest liquid assets because everything else has been spent on living and their home might be their biggest asset, but the biggest liquid asset is tax deferred. And this is where you oftentimes have the most maneuverability within your tax situation. This example is going to say, hey, listen, this couple where they have the majority of their assets tax deferred, if they didn't do any sort of conversions, they would be looking at a lifetime estimated projected tax bill of $1.2 million. And the reason for that is that the majority of their income is being taxed at the 24% federal tax bracket or 32%. They're getting into a situation with Medicare costs where their income is too high, so they have IRMA surcharges. They're having Social Security tax at the full rate, and they basically have limited flexibility because once RMDs, required minimum distributions, kick in, they are effectively stuck. Their tax bracket is forced into a higher zone. So how do you manage this? Well, commonly, if you retire early and at 62, let's say you retire at 62 and your required distributions start at 73, that's a 9-year window where you might not have a ton of income, especially if you haven't started Social Security yet. So what do? You start to take money out of those tax deferred vehicles, whether you're doing Roth conversions or just taking that outright. But what you're trying to do is capture it at the 0, 10, or 12% tax bracket. And you can see for married filing jointly, the 12% tax bracket's up to $100,000, and that's really after standard or itemized deductions. So in this case, we're saying they could save up to $557,000, and so there's just an illustration of $1.2 million lifetime tax bill versus $643 because most of the assets are being taxed at 0, 10, or 12%, not at 24 or 32, and we're avoiding some of the pitfalls of IRMA surcharges, Social Security maximum taxation, and also talking about gifting strategies, right? So ways to reduce the impact of taxes. So RMDs kick in right now if you're born in the 50s, they kick in at 73. If you're born in the 60s, that will be at age 75. But one of the biggest things, if you're already making charitable donations, rather than making them out of your taxable accounts and then trying to get a deduction on your taxes, which is not guaranteed, qualified charitable distributions where you send money directly from your 401k or IRA to a charity, and you can do up to $111,000, that makes way more sense because you're never recognizing the income. And that's really important because there are certain income thresholds where if you go above it, you're starting to get into surtaxes and all of these other items that you want to avoid. So not recognizing income at all is way better than recognizing it and trying to deduct it. So again, we talked about pre-RMD Roth conversions, where if before these required minimum distributions kick in, you're doing Roth conversions or getting money out of the accounts, and avoiding the 2RMD trap where you basically, they give you up until April 1st of the next year, of the year you turn 73 or eventually 75, or avoiding stacking them up. So you basically just have a plan to make sure that you're strategically taking your RMDs in the most tax efficient way possible. So every strategy has a timing decision, right? And so with all of these things, there are different times where you would want to deploy these. Asset location is something that sort of lives across the lifetime of your account, but this is when do you recognize gains? When do you harvest losses? Which accounts do you hold these things in? Roth conversion strategies. Most pertinent when you are retired and your income drops and you have a lot of tax deferred assets. And again, you can do it at a lower tax rate. Tax loss harvesting, this is effective basically at any time, but it could be more effective in years where there's higher gains or higher income. Required minimum distribution management, we've talked a lot about that, avoiding just basically doing nothing and then having these massive RMDs where you're going to be in a high tax bracket for the rest of your life. And then deduction bunching. So we talked about charitable deductions if you make donations to charity, but they're not always deductible. So there are times where people are making these deductions, but they're not itemizing on their taxes because they don't have enough. So they're really not getting a deduction. They might think they are, but they're not. So how do you avoid that? Well, you can bunch donations. So let's say you're giving away $2,000 to $3,000 a year to charity. Rather than doing that every year and getting no deduction or a limited deduction, you could bunch them all together and use a vehicle like a donor advised fund where you're figuring out the year where you have the biggest tax liability and you're doing $15,000 at one time. And that's allowing you to itemize because you're having a big deduction in one year. And then through that donor advised fund, you can meter the funds out to the charity $2,000 to $3,000 at a time, right? So for all of this, with all of the concepts that we talked about today, there are very specific nuances for each person that I work with on which one of these levers you pull and when. But it necessitates having a big picture plan and having investments that tie in with a tax strategy and somebody that can work through all of that. Because having been in the industry for close to 20 years, what I can tell you is that even if you have an investment advisor and a very good investment advisor, the likelihood that they're integrating with your tax preparer probably relatively low. So when I started Vineyard Wealth Group, it was important for me to not only help with the tax strategy, but to prepare taxes. And for the majority of my clients, I not only manage their investments, but I also prepare their tax returns, which allows the execution of these strategies to happen where oftentimes they're talked about at a big picture level, but they're not really happening behind the scenes because it's too hard and too cumbersome to manage that. So if you do not have somebody that has put together a financial plan and taken a look at how you can minimize your taxes, my information's up there. You can follow us on Instagram, go to our website, book a complimentary meeting, email, call. We hope that you learned something today. We hope that you like this video. Subscribe to our YouTube channel. We will be diving deeper into a lot of these tax strategies via case studies and other presentations in the near future. So we hope that you follow along with that. And thank you for watching today.